Well, good evening. This is June 21st, 2016. This evening's SDRAFocustm Webinar is on common questions and answers. We get Q&A from people all the time, and we like to pick some of the more interesting ones to see if we can discuss it for the benefit of our SDRA safeguard clients. And so tonight we're going to be talking about three actual specific questions. But before we do that, I just want to make sure that everybody understands who's attending this, that this is not, we're not intending to give a legal opinion, that what we say on this webinar can't be used to avoid any taxes or penalties, tax penalties. And if you'd like a written opinion on anything, we're very happy to do that. So please contact us. So here are the common questions, and I should start off by saying that there are very few questions in the self-directed IRA area that are where there's clear answers. There are some cases on on various different types of issues. There are some regulations, there's the code, of course, but there are not a lot of definitive answers on a lot of the questions that annoy us as time goes by that there really should be simple answers to. So, for example, we all know the problem of the Swanson case and the fact that you can invest in an LLC 100% with your IRA and you can put more money in anytime you want to. But if you co-invest with your IRA or your self-directed retirement account, the retirement account can't put more money in after that because it's considered, the entity is considered to be a disqualified person. And of course that makes no sense. So I've submitted something to the Department of Labor, and it's probably going to take them a number of months to respond to it, but I did have a conversation with a guy there who came up with the key question and asked me, you mean that a self-directed retirement account can be considered a disqualified person with respect to itself? And I said, you got it. That's the way the interpretation has to go right now based on that footnote in the Swanson case. So anyway, there are really no definitive answers, and we're looking to see if we can get a class exemption from the Department of Labor for that kind of issue, subsequent investments by IRAs when they're co-invested with. And, you know, maybe we can get that exemption and we'll see what happens. Then we don't have to worry about it. But tonight we have three fairly common questions that people ask us. And again, these are not things that are really clear. There's no specific regulation. There are a lot of cases, particularly in the bankruptcy court, on things that can disqualify an account, but there are a lot of detailed kinds of questions that you know, are bothersome. There's no clear answers. There's not a lot of cases, and all you can do is really kind of piece together what you think is the right, reasonable answer, and then be conservative. So the questions tonight are, and we get this fairly often when the annual filing for LLCs comes around. The client wants to know, can they pay the annual filing fee with the state, or does the IRA have to pay it from the LLC? This is usually in the 100% ownership context. And if I pay the annual filing fee, can the LLC reimburse me? So that's the first question. The next one is, how do I make a distribution for my self-directed IRA? That can be fraught with difficulties, and it does take some thought, careful thought in figuring out exactly what you're doing. And then finally, this is the $64,000 question. Are there any circumstances under which I can be compensated by an LLC in which my self-directed IRA has invested? Now, most people will say the answer to that is never, and that is the most conservative answer. There are, however, some Labor Department regulations that we'll be talking about that suggest that there are, in fact, some circumstances where that can happen, and we'll talk about that. So, first question, paying annual filing fees. Should I pay the annual state filing fee for my IRA LLC? And can it be reimbursed by the LLC? And there are really two sides to this puzzle. The first is what kinds of reimbursements can we be permitted to get? And what about prohibited transactions? And the other side of the whole puzzle is annual limits on contributions, because if you pay something for the LLC that the IRA should pay itself, are you making an indirect contribution? So the first half of that is potential prohibited transactions. So what exactly, what are the prohibited transaction rules that could be violated? And there are really two of them. One is the lending of money or extension of credit between a plan and a disqualified person, because if you intend to pay the fee for your IRA, are you actually lending money to the LLC that's owned by your IRA? And the second is, can you transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan? And that would apply theoretically if you reimburse yourself from plan assets from the LLC's cash. So, but there are some exceptions to the prohibited transaction rules, one of which is particularly interesting and important in this particular context, and that is 4975D10. And that says that a receipt by a disqualified person of any reasonable compensation for services rendered or for the reimbursement of expenses properly and actually incurred in the performance of his, and I should insert, or her duties with the plan. So that's the exception. Notice that there's a couple of restrictions on that. One is, of course, that it has to be properly and actually incurred. And of course, it's hard to know what properly means in this context. And it has to be actually incurred in the performance of the disqualified person's duties with the plan. So you have to take a look at, okay, what duties do I have with the plan as the IRA, in particular in the IRA context, as the IRA owner. So yes, there is an exception to the prohibited transaction rules, but there is also an exception to the exception. And I have fun sometimes when I'm speaking about these rules, talking about the exception to the exception to the exception, but we won't get there tonight. And there is a section in section 4975. It's subparagraph F6, and that says, and it's a very convoluted section, but I'm going to summarize it for you. The exemptions, in particular the one I just described to you, do not apply when a plan lends any part of the corpus or income of the plan to, pays compensation for personal services to, or acquires property from or sells property to an IRA owner. So the question then is, does that prevent section D10, that's the one we talked about before, from applying to anything? I would say that the answer to that is no. And of course, the question on the screen here is, does the D10 exception apply? And the answer is yes, where you're reimbursing yourself for expenses, because those aren't listed among those three particular types of transaction. So that restriction is limited to particular types of transaction between your retirement account and you or members of your family or entities that are disqualified persons with respect to your retirement account. But in our context, reimbursing ourselves for expenses properly and actually incurred does not seem to fall within any of those exceptions to the exception, and so we're okay with D10. So then our questions really are, was the expense properly or actually incurred in the performance of your duties with the IRA? Well, of course, state filing fees have to be incurred for the LLC, because if they're not, the LLC will be disqualified. It will end up terminating its existence, and that can be a major disaster for you, because if the entity terminates its existence and you're handling the account with IRA money in it and writing checks, that could be considered prohibited transactions and even a distribution to you. So you don't want that to happen. So it's really important that the expense of paying the filing fee actually be incurred. So the next question is, well, what are your duties with the IRA that mean that you should incur that expense? Well, in the context of all plans, retirement plans, IRAs, 401ks, etc., there's something called settlor functions and fiduciary functions. So as the IRA owner, you are a fiduciary of your IRA. And that's because you, under the code, you have the ability to make discretionary decisions about the investment of the IRA's funds. And so as having that power means that you are a fiduciary, which puts you into the context of being a person who is subject to the prohibited transaction rules. But you do have duties as the fiduciary, and one of the duties is to avoid a situation where the IRA holds an interest in an entity that gets dissolved. And you know, in most cases, people come to us to form the entities, they pay us their fee to form the entity, and then they instruct their IRA custodian to make an investment in the entity. But once the IRA is invested in the entity, it owns the entity, and so it should be paying the expenses of the entity, and annual filing fees are typically an expense of the entity. So it is well within the performance of your duties as the owner of the IRA, as the manager of the LLC, excuse me, to make sure that that expense gets paid. And so I would say that it is appropriate, definitely appropriate, that the expense be paid. And the question then is, all right, should you pay it? Well, if you're allowed to reimburse yourself for expenses properly and actually incurred in the performance of your duties with your IRA, then the answer would be yes. And was the expense one that was properly incurred by the IRA? Well, I would say definitely yes, based on our understanding of what the IRA needs. So my answer to that question typically is yes, you should reimburse yourself from the IRA, from the LLC. The LLC should pay you exactly the amount that you paid for your filing fee, and you should be sure to make sure that you have excuse me, receipts to verify that you actually paid the expense. Of course, it is much better if you can do it, to have the LLC pay the expense, the filing fee, the state filing fee, directly to the state by sending a check with the filing fee. But oftentimes it's much more convenient to pay online. And so for that you need either a credit card or a debit card. And many of our IRA owners don't get debit or credit cards for the LLCs. So in many cases we end up paying the filing fee and then get reimbursed from the IRA or the IRA owner. So what happens if you don't reimburse yourself? Well, okay, in that case, the IRA, as the owner of the LLC, in particular in a situation where it's 100%, has an expense that it has not incurred and that you have. And that could be considered an indirect contribution to your IRA. Now, is that really significant? Well, I don't know. If you make an indirect contribution to your IRA, it only has a consequence if for that year you make the full permitted contribution to the IRA other than having paid the fee for the IRA. And so if you don't contribute the full amount that you can contribute for that year to the IRA, there should not really be a problem in that direction. And the amount is so small that if IRS were coming along, they probably wouldn't think it was worthwhile going after you for penalties on paying excess contributions. 10% of the filing fee would be a very small amount. So it's unlikely that IRS is going to be pursuing something like that. And if third parties are trying to disqualify your account, it would not be a prohibited transaction for you to pay an expense for the LLC, but not get reimbursed, because in that case, okay, maybe you've made an indirect contribution to your IRA, but you certainly haven't dealt with IRA assets. So paying the state filing fees and being reimbursed for them is okay, and even paying the filing fees and not being reimbursed. Now you might ask therefore, well, what about the other fees that my self-directed IRA incurs? What about the fees that I pay to, for example, the custodian? The custodians allow their customers to pay the fees with their own charge cards or to deduct it from the retirement account itself. And the reason for that is that the entire issue of expenses properly incurred by or on behalf of the retirement account and who pays them is kind of up in the air. There are lots of advisory opinions from the Labor Department talking about whether the person that establishes a retirement plan can be reimbursed for expenses that they've incurred. And there are a lot of things like that, but nothing really paying specific things like filing fees, which are obviously, there's no issue of valuation, and there's very little on who pays account fees, etc. So until there is clarity on that issue, most custodians are allowing it to be done both ways, and this is pretty much along those same lines. So do we have any questions so far? Let me see, I'm going to unmute everybody. Any questions?
No, I'm good, Frank. Thank you. That was very useful because it certainly applies to me.
Any more questions? I saw somebody unmute themselves, so I'm asking if you wanted to ask a question. Oh, they've remuted themselves, so let's go on to our next topic. So the question is, how do I pay distributions from my self-directed retirement account? Now this comes up a lot for people who have to make minimum distributions, and minimum distributions have to be paid by April 1st of the year following the year in which you reach 70.5. The vast majority of our clients who are doing self-directed retirement accounts are under 70.5, but we have some, and so it does come up. So how do you figure out what the minimum distributions are going to be? And they have to be paid by December 31st of each calendar year after the year in which you reach 70.5. Of course, so for the year that you reach 70.5, you have to pay the minimum distribution by April 1st of the following year, and then that following year you have to make the minimum distribution for that year. So then, of course, there's other distributions, and you can make a distribution to yourself anytime that you're older than 59.5. Of course, if you make distributions to yourself when you're under 59.5, that could be a problem. You've got penalties and interest and that kind of stuff. But you can make a distribution to yourself anytime you're over 59.5, and all you have to do is worry about the income tax issues. So the first thing to really understand on this is that what we call the aggregation rule for minimum distributions. Now this is a rule that applies only to IRAs, so it does not include your employer plans, your 401ks, and that kind of thing. It does not include Roth IRAs because Roth IRAs for individuals who establish them don't have minimum distribution requirements. And so you can add up the value of all your IRAs, whether they're self-directed or not, whether they're invested in private property or not, and calculate what your minimum required distribution is for that year. Now that's calculated by dividing the value of the account from which the minimum distribution is going to be done by a divisor, which is based on a table that's issued by IRS. There are a number of different tables, but the Uniform Lifetime Table is the most common one that's used. So if you're 70.5, you're supposed to make a distribution of 1 divided by 27.4 times the value of all of your accounts. So that's typically that's a small amount, depending on how many accounts you have and how much you have in IRAs. But each year that number changes as you get older, and that's a divider that's based on what IRS says your life expectancy is at that particular time. So, and it's recalculated every year, so it doesn't go down 1 year every year. It goes down a percentage or a few decimal points each year. So you add up all the value of your IRAs and you multiply that by 1 divided by the divisor to figure out what the actual amount is you're supposed to take as a distribution. Now you can take the total minimum distribution from any one of your IRAs. That's the aggregation rule. So if you have an IRA with, let's say, $500,000 in it, and you have a self-directed IRA with another $500,000 in it, and your minimum distribution is, let's say, $20,000, you can take the whole $20,000 out of the IRA that has cash in it. You don't have to take distributions from the self-directed IRA if you have an account with enough cash in it to make your minimum distribution. So, and you don't have to take it pro rata from each IRA. So that's important to note. Now, we have some clients who have all of their IRA money invested in self-directed IRAs, so they're not going to be able to find, they're not going to be able to use the aggregation rule. So we divide the total value of all the IRAs by the annual divisor under the IRS tables, but the real issue then is, now you know what the number is. The next question is, okay, if I'm going to make the distribution from my self-directed retirement account and it holds assets that are not easily valued, how do I go about that? Well, let's say, for example, that you have an LLC that's 100% owned by your retirement account. And what you have to do is you have to value the LLC interests on December 31st of the prior year, and that's the number that you use for distribution for this year if you're doing minimum distributions. So that's why the custodians always want that valuation information early the following year, because in many cases, not so common in self-directed accounts, but in most cases they're going to calculate what your minimum distributions are once you're 70 and a half, and they're going to send you a notice in January or February saying, this year your minimum distribution is whatever the number is, and that's based on the value of the account at the end of the prior year. But what do you do if you've got LLC interests? Those aren't easily valued. Well, then you have to value the LLC. And you know, the other kind of thing that we can run into is promissory notes. Commonly we have LLC interests in our practice, and commonly we have promissory notes that are held by self-directed retirement accounts. Well, promissory notes are fairly easy to value. The IRS wants us to value them based on the principal amount that's owed plus any accrued interest on December 31st. So that's fairly easy to value. The problem is that when you've got an LLC and it's got other kinds of assets besides promissory notes and cash, then you've got to figure out how you're going to actually value the LLC interests. So here's how it works. The LLC interests, where the typical example is where the LLC holds real property. You determine what the property value is on December 31st, and we'll talk about that in a minute. You have to add any net cash in the accounts on December 31st, and by that I mean what is the bank balance less outstanding checks. So your actual just reconciled cash balance in your checkbooks, etc. You have to add the value of other assets like personal property. Some people have washer dryers in their buildings and things like that. And then you have to deduct any liabilities to third parties. So if you owe bills to the plumber or to carpenters or things like that, if it's outstanding on December 31st, you have to deduct them. And that will give you the net value of the overall LLC. And so if you have 100% owned LLC, well, you know then that what the value of all of the LLC interests is, excuse me, And then you multiply that times the amount of the minimum distribution, and you can value the individual interests in the LLC by doing that. So let's say we had 1,000 units of the LLC, and the interest and the total value of the property inside the LLC was $200,000. That means that each LLC unit is worth $200. So you divide that into the amount of the minimum distributions you have to make, and that tells you how many LLC interests you have to distribute. Now, if you have only a proportionate part of an interest in an LLC that holds real estate or other assets, you still have to go through the same value, the same valuation process to determine what the net value of the entity is. But then you have another problem. At that point, okay, let's say that you own 20% of the LLC and an independent third party owns 40% and another one owns another 40%. Well, you are a minority holder of the LLC interests. And that means, A, you probably don't have any control over how the entity is managed. Because of the way LLC operating agreements are written, and because of the way they're set up, most members of an LLC do not have the ability to withdraw and get cash for the value of the LLC interests, and they can't sell them to third parties. So in the tax context, if you have a minority interest in an LLC, you get what are called valuation discounts. So there's a difference between the value of the LLC and the value of the units in the LLC when your retirement account doesn't own 100%. So if you have a 20% interest in it, you might get a 35% discount off of the value of the total LLC. So that means that the number of LLC units that you have to distribute is less. And that's actually a good thing because it means that you don't have to distribute pro rata. You get to leave more of the money in your LLC. So you multiply that percentage of your ownership times whatever the value of all of the LLC interests is, and that tells you how many units you have to distribute based on the calculation using the minimum distribution amount. So then we have the question, well, how do we go about distributing? Well, of course, what we have to do is we have to give instructions to the custodian to distribute the number of units equal to the pro rata value owned by the retirement account times the minimum distribution amount. And that can, if you've got an 100% owned IRA LLC, that can create a problem because now you are a co-investor with your retirement account. So let's say that you distributed $10,000 of LLC interest to yourself, and there's 200,000 units at $1 a unit. Well, now you've got a small proportionate part of the total, and now we have that Swanson rule that we have to worry about, A, because now the entity becomes a disqualified person with respect to your retirement account because it doesn't own 100%. And the retirement account and disqualified persons owns a majority. So, and that's that whole crazy Swanson footnote rule that we worry about so much. So that's not necessarily a really good place to be in, unless, of course, you don't have to worry about contributing additional units or additional cash to the LLC. Now, what my solution would normally be would be, okay, let's say the LLC needs extra cash. I think that what we would do would be we'd reorganize the LLC so we have some units that are subject to assessment or subject to call, and some units that are not. And the units that are subject to call are the units that you own, and the units that are not subject to call are the units that your retirement account owns. So if you have to put more money in, the ownership of the entity gets adjusted. So you're not making a loan to the IRA. You're just actually buying more units. And so if you now have 220,000 units, now then everybody is diluted to some extent. Your retirement account is diluted to some extent, but it was necessary in order to meet the cash need. And your retirement account can't make that extra investment because of the Swanson rule. So we have to be very careful when we're paying minimum distributions or paying distributions at all from a single member LLC, because we're used to being able to put more money in whenever we want to in a single member LLC, and that whole bandwagon can terminate very quickly, unless of course we can get that class exemption from the Department of Labor. So that's the fundamental problem with making minimum distributions or making any distributions with self-directed retirement account, particularly LLC interests. You end up changing the ownership percentages. So now the question is, how do we value the property that's in the LLC? Well, we kind of passed over that before, but let's say we have real property in there. And of course, with real property, there's generally three options. We can use the most recent real estate tax assessment. If we bought it recently, we can kind of rely on the purchase price, because purchase prices for real estate, at least in Massachusetts, don't change that dramatically over time. So if you bought it 6 months ago, maybe you can use that purchase price, because that would be the fair market value based on what a willing seller and a willing buyer were willing to receive and pay. So that might be one. And then of course there's getting an appraisal. Now if the property is a commercial property, the appraisal can end up costing $10,000 to $12,000. But of course if it's just a single family residence, it might cost a few hundred to get the appraisal. So that's an issue. And the question then is, who pays for the appraisal? Well, you're the one who wants to make the distribution. So my sense is that you would pay for the appraisal. But in some cases, entities are actually issuing units to self-directed IRAs with the understanding that an appraisal is going to be done periodically so that they can make distributions, and they can, for example, convert their retirement account to a Roth, so they can rely on those appraisals. But those are situations where the purchase price of the units was adjusted based on the need to have appraisals, where other investors did not need the appraisals, so their purchase price for their units might be less, different classes. So my sense is, you've got to pick the option that you think is best, that you think is appropriate in terms of your circumstance. You'd also have to value the promissory note if you have them like I described above. But the real issue is, which one are you going to pick? And that's an income tax issue. Because if you make an underpayment of your minimum distribution, there is a penalty equal to 50% of the required minimum distribution less the amount that was actually distributed for that year. And remember, you can make your minimum distributions for subsequent years by April 15th of the following year, which is kind of cool. No, I'm sorry. It has to be done by December 31st of the year. Disregard that, please. So, you can end up with a payment, an underpayment, and that means that you've got a penalty. And of course, there is no penalty for an overpayment. IRS is very happy to have you incur more income tax than you might otherwise want. So it's very important to pick a valuation method that you feel very comfortable with and that you feel that you can justify if IRS argues that it's the wrong value. So then the question really is, how confident are you that the valuation will hold up to scrutiny? And then of course there's the subsidiary issue of whether the penalty will be enough for IRS to pursue. So, if there's issues on whether the valuation is correct and the difference in value could be $10,000, that might mean that the minimum distribution requirement is a very small amount, so it isn't worth IRS time and effort, since they're short-handed now, to go after penalties for that. But of course, if you've got large amounts of distribution, they're going to be interested in finding out what you did. And the other part of it is that when you file your income tax return, if you don't report the minimum distribution that you should have taken, you are also underreporting your income. So you can end up with all kinds of different problems and different penalties, and if it happened a few years ago, you can end up with interest on those penalties and extra taxes. So it's important to take a very careful approach to this when you're paying distributions from your self-directed retirement account and valuing them. So our third issue is the compensation issue. Are there any circumstances under which I can be compensated by an LLC in which my self-directed IRA has invested? And of course, this is a really very common question we get. A lot of people call up when they want to do a transaction or want to make an investment. One of the subsidiary issues that they want to ask is, can I get paid if this is an enterprise? Can I pay myself a salary if I'm going to work for it? And typically the answer is, please don't do that, because the real answer to that is in most cases you can't. And so let's talk about how that works. So Section 4975 prohibits direct or indirect furnishing services between a plan and a disqualified person. It prohibits the transfer to or use by or for the benefit of a disqualified person of the income or assets of a plan, of your IRA. And it prohibits dealing with the income or assets of the plan in your own interests or on your own account. So all of those could come into play if you pay yourself from plan assets or from the cash that's inside an LLC or in a business that's your IRA has invested in. Now, there is an exception, and that is the one that we talked a little bit about before. This is the contract or reasonable arrangement made with a disqualified person for office space of legal, accounting, or other services necessary for the establishment or operation of the plan if no other reasonable compensation is paid therefor. We've talked about that in other circumstances on our webinars. So note, however, that this exception is limited to services necessary for the establishment or operation of the plan. So if if your IRA is invested in an LLC, and the LLC is a widget manufacturer, for example, and the widget manufacturer has hired you to work on the line or as an executive or something like that, those services are not within that exception. The exception only applies to what we call settlor kind of function services or fiduciary kinds of services that are necessary for establishing or operating the plan itself. So in the context of reimbursing yourself for expenses from the LLC for the annual filing fee, well, that expense really is necessary for the operation of the plan. But if we're talking about paying you for running errands for the president or being on the assembly line or sweeping the floors or that kind of stuff in the property, then that exception would not apply. And then, of course, that's that old section 4975 F6 says that the exceptions don't apply when an IRA directly or indirectly pays compensation to its owner, family members, or other 50% owned disqualified persons. In other words, an entity in which disqualified persons own 50% or more. So the exception under D2 does not apply in this context. So the question then is, all right, so what does directly or indirectly mean? Because, you know, everybody knows has probably heard of what the butterfly effect is, and that that's out of physics, and that essentially is, it says that when a butterfly in Mexico flutters its wings, it has effects on the growth of plants in New England, that kind of thing. So a very, very remote, indirect effect because everything in the universe is connected together, but that doesn't mean that we would normally consider that either a direct or indirect effect between the butterfly slapping its wings and the growth of the grass. So how many degrees of separation do we have to have before a transaction that involves in some way the assets of a plan is too remote to be indirect within the definition of Section 4975 of the prohibited transaction rules? Well, we don't know that. There isn't really an answer to that. There have been a number of cases on the issue, and courts have differed quite dramatically in their approach. You might say, well, it has to be intentionally done. If I have a transaction with somebody that is an entity that is dealing with another entity that my retirement account has invested in, is that an indirect transaction with my retirement account? Well, the plan asset rules say that the second entity's assets are not plan assets, but still, is that indirectly dealing with my retirement account? So how many degrees of separation do we have to have and that kind of stuff? Well, obviously, if you're being compensated by an entity in which your retirement account has invested, there's not too many degrees of separation between what the effect of your services is and what the retirement account is doing. And what we're talking about here is a situation where the retirement account has invested in an entity, but it's not the only investor, and the entity is an operating company within and that's a term of art used by the Labor Department in determining what plan assets are, because you can't have a prohibited transaction unless you're dealing with plan assets. So if you're investing in an entity that provides services or products to the public, the entity typically is considered to be an operating company. So although the plan owns the stock or LLC interest in the entity that it holds, it does not have an undivided interest in the undivided assets and the underlying assets of the entity. So the cash that's in the account of the entity is not considered a plan asset. Now that is the source from which this whole question arises. Well, if the cash that's in the entity is not a plan asset, then surely I can pay myself. Well, then we still have to worry about the directly or indirectly. And as a matter of fact, the Department of Labor has actually given guidance on this issue. And I'm going to preface these remarks by saying that it is not entirely clear that the DOL's guidance that I'm going to explain to you actually applies under Section 4975. It's all written as if it were applied under ERISA, which has a whole set of different sections that describe what prohibited transactions are. But the sections that are relevant here are worded exactly the same as the prohibited transaction rules in Section 4975. So most of us think that the DOL guidance would apply in some context in some way. But there's still, I have to say, there aren't any cases that actually discuss this issue. So we're going along trying to be as conservative as we can, but looking for guidance where we can find it. So the Department of Labor issued this interpretive bulletin, and the citations here on the screen. And what it says is essentially that, if you're looking at a transaction, your IRA is invested in this entity. The entity is having a transaction with you. And what it says is that if the transaction between you and the entity would be a prohibited transaction if it were occurring between you and the retirement account, then it doesn't matter that you've got this intervening entity, and it doesn't matter that the entity's assets are plan assets. It's considered a prohibited transaction. But there's exceptions to the exceptions. And this interpretive bulletin is one of the most difficult to interpret among the interpretive bulletins that the Labor Department has issued. So the first thing is, it says that if a plan by itself can require the entity to engage in the transaction with the disqualified person, then the transaction will be considered a prohibited transaction. If the disqualified person and other disqualified persons, with the aid of the plan, but without the aid of any other person, can require the entity to engage in the transaction, then again, that will be considered a prohibited transaction. And that's a situation where, for example, let's say your IRA has purchased 20% of the entity and you own another 40%, so between you and your IRA you own 60%, and voting is divided pro rata. That means that you and your IRA can require the transaction to be done, so it will end up being a prohibited transaction. But that rule does not apply if the disqualified person, together with other disqualified persons, may by themselves require the entity to engage in the transaction. So the implication of that is that if your retirement account has invested in an entity and you're a co-investor and you own 51% personally and your IRA owns another 10%, you, because you're the disqualified person, since you can require the entity to engage in the transaction, then it's not a prohibited transaction with your IRA. Now, that seems a little bit counterintuitive. And the reason and the fact that that doesn't sound right is the reason why many people try to steer away from it anyway. But the rule is there, and it does say that if disqualified persons, let's say you and your spouse have invested a total of 51% of the entity and your IRA owns another 10% in those third parties, then theoretically, since the disqualified persons can require the transaction, then it's not going to be a prohibited transaction with the retirement account as long as the entity is an operating company and the entity's assets are not plan assets. So what many people have tried to do is to say, well, we'll establish an LLC where there's voting units and non-voting units. And the voting units will own 1% of the entity, and the non-voting units will own 99% of the units of the entity. And the managers are voted upon only by the voting units, and the managers in the voting units by themselves control all aspects of the operation of the business, and the non-voting units have no control over any of that. They just get the distribution when they come. And that is the situation where the Labor Department's guidance would suggest that since disqualified persons may by themselves require the entity to engage in the transaction, that theoretically, if the disqualified persons own that 1%, now the managers, theoretically then, that should be okay. Well, I try to be a little bit more conservative than that because it just scares me to be able to rely on that until there's actually a case that follows it in the context of Section 4975. I would be reluctant to follow it myself. However, let's suppose that there are unrelated third parties and the entity is owned 51% by the unrelated third parties. Well, in that case, none of those prior rules apply. The IRA cannot require the transaction. You cannot require the disqualified persons cannot require the transaction. And so if all of the unrelated third parties can require or veto the transaction, then it should be okay, provided that the entity is an operating company. So in the context of structuring entities, when there are multiple investors, I usually try to have unrelated third parties be in control of decisions that would involve disqualified persons and transactions with the entity, so that we don't end up with disqualified persons being able to control what the retirement account is able to do, and so that they can get the benefit of the retirement account themselves. Now, there is another rule. You might say, well, okay, I and my 3 buddies, we're going to start an LLC. We're going to develop some real property. We're each going to own 1/3. I'm going to own my 1/3 in my retirement account. My other 2 independent buddies are going to own theirs with their own money in whatever way they want to. In that circumstance, my retirement account can't control anything. So we're going to agree beforehand that I'm going to provide services to the entity because I'm a contractor, and that's one of the reasons they want to work with me. Well, there is one other rule, and that is the rule about prior arrangements. And that means that if you enter into a transaction with an entity, expecting, if you make an investment of retirement account money in an entity, expecting that the entity will have a transaction with you, that is a different kind of prohibited transaction, and that interpretive bulletin that I just described to you specifically says that in that circumstance, it's a prohibited transaction. And so those rules about control, etc., don't seem to apply in that circumstance. So usually the real circumstance where a disqualified person could be paid by an entity would be, for example, where, let's say we had those 3 parties. The IRA is an investor. The IRA's owner is just a pure investor. They're not working for the company. They're not playing. They don't make the investment with the intention of working for the company. And then 5 years down the road, their son or daughter graduates from college, and they want to go into real estate development, so the entity hires them. Well, that would be a situation where disqualified persons can't control the decision. It's in the hands of independent persons, and it was not done by prior arrangement. So in those circumstances, I would say that might be okay. But you can see that there is, now we're limiting the number of circumstances pretty far down to the types of circumstances that can be, where disqualified persons can be paid. So for a 100% IRA-owned entity, that's a circumstance where no compensation can be paid to the manager, and all of our single-member LLCs specifically say that the manager cannot be compensated. They can provide services, but those services are the services that are allowed under that exception for services that are necessary for the operation, establishment and operation of the plan. So as a manager, you get to decide who's going to perform the services. You get to decide where the accounts are going to be deposited, the money's going to be deposited, and you can do particular types of services of that kind, and that's okay. Hello? Please stop. I'm in the middle of a conference here. Sorry for that interruption. Testing my audio. Yes, okay. So I'm doing fine. So the next situation where the entity is majority owned by the IRA, and again, you can't have any compensation there because the IRA is in control. If the entity is majority owned by the IRA and disqualified persons, again, there's no compensation allowed there because that's the second tier of the circumstances where the Labor Department's guidance says that's a prohibited transaction. If the entity is majority owned by disqualified persons, in other words, the IRA is a minority owner, is compensation okay? Well, again, that seems counterintuitive to me, and if we want to be conservative, I would typically say let's try to avoid that unless it was absolutely necessary, in which case I would say just understand that the risk is that you're going to end up disqualifying your account. So typically we try to avoid that. And then thirdly, where the IRA and disqualified persons are in the minority, that seems to be okay, provided that there is no prior arrangement. And here's the prior arrangement rule, and that is if a plan invests in a company and as part of the arrangement, it's expected that the company will enter into a transaction as part of the arrangement. The transaction can still be a PT even if the plan and disqualified persons are in the minority. So to summarize, if the investment is made by an IRA and part of the arrangement is that the entity will engage in a transaction that would be a prohibited transaction between the third party and the IRA, it's still a PT. It's a prohibited transaction. If there's no prior arrangement and the disqualified persons can require the transaction without the aid of the IRA, it's arguably not a prohibited transaction, but again, that's one of those ones where we try to avoid. And third, if the IRA and disqualified persons can't require the transaction, third parties are in control, and there's no prior arrangement, it's arguably not a PT, and I would feel much more comfortable in that circumstance. So, thank you very much. I hope this was helpful to you. It's been recorded, and I look forward to having conversations with you. If you have questions, please feel free to call us. 617-630-5700, extension 1 is my extension, or email me, and you all have my email address, but I'll repeat it. It's fbridges@hdlawgroup.com. So thanks very much, everybody. The next webinar will be in September. There will be no newsletters in July and August, as is typical, as is traditional in our program, but our next webinar will be in September, or it might be in October. We'll be establishing a new calendar for the next Cyber Safeguard calendar year, which starts July 1st, and you'll be receiving notices of when those events will occur towards the end of the summer. So thank you very much for attending, and I look forward to talking with you.